Hi, everyone. This is Jason Bierach of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is co-founder of the Capitalist Times. He has over 20 years of experience as an investment analyst covering dividend stocks, utility stocks, master limited partnership investments in the oil and midstream industry, and also oil stocks. Roger Conrad, thank you for joining me again.
Thanks, Jason.
Now, Roger, I want to have you on to discuss the oil market because you have more experience with master limited partnerships and the oil market than I do. And since you've survived multiple bear markets in the oil market, I want to get your opinion on the oil market right now. You know, we have a situation where everyone's talking about a supply glut, and we're starting to see some production cuts, and OPEC's talking. Do you think the bottom is in the oil market yet?
We think we're going to have one more whoosh down. I think probably bottoming somewhere in the $20 to $25 per barrel range on the WTI, and that's primarily driven by the supply situation and the fact that we are coming into a soft time of year for demand for various refined products. So we have glut of products at refineries and we haven't really quite seen those production cuts yet, so it takes a while for these markets to balance. But that's our view. We're going to see one more kind of whoosh down, and but followed then by a recovery of sorts. And our longer-term view, and this would be kicking in somewhat later this year and lasting for possibly a number of years after, would be what we would call a lower for longer environment of between $40 and $60 a barrel on WTI for oil. So a longer period where prices are much more subdued than they were a couple of years ago. We think that there are a number of companies that can do well in that environment. There are a much larger number of companies that won't do well in that environment because, keep in mind, a lot of this industry really did start up under $100 oil. So we're looking for a lot more carnage, punctuated by a lot of volatility, some really strong returns for a handful of companies, but also a lot of risk for anybody investing in energy as well.
Yeah, I think it's a stock picker's market, like you pointed out. I don't think every firm is going to survive, especially the ones whose costs are too high, and the other key one is debt. So the ones who can't cut costs fast enough and the ones who have too much debt on the balance sheet, especially debt that's due in the next year or two, those are the ones that are going to run into the most problems.
Yeah, I would definitely agree with that. And I think, it's often, for investors that try to look, go down and look at metrics and pick their stocks that way, I mean, that has a utility up to a point. But if you look back at what happened in the late 80s, the survivors, the companies that came out of that supply-driven catastrophe for oil prices were all the kind of recognizable names. They enjoyed a low cost of capital. They didn't necessarily have the best debt to EBITDA ratios or the best dividend payout ratios or even the lowest cost reserves, although that definitely helped. But they were the companies that were able to continue accessing the capital markets, and that's one big advantage the super oils have. Companies like Exxon, which not only went up considerably in the later 80s, but also beat the S&P 500 by a pretty substantial margin. Again, it's a lot of those factors you named. I think looking around the horn, it also is going to have a lot to do, at least in the U.S., with what sort of shale basins companies are operating in. And not all shale basins are created equal. Some are lower cost, some are better situated geographically than others. And looking down the producers to midstream companies, the companies that are in those better basins are going to be advantaged. So we see a big drop in production, oil production, gas, as well as gas liquids as this market rebalances itself in North America. But eventually we're going to have some big winners that are going to increase their market share and really dominate the market. So, again, keep in mind, a lot of this industry was raised on $100 oil. And now that we're going to have, for a considerable period of time, I mean, right now it seems like a pretty good thing to have $40 to $60 oil as opposed to $20 to $30. But that's not going to be high enough to help a lot of the companies out there. So it's, again, a real time to be extremely selective in what you look at.
Yeah, I believe in the Warren Buffett contrarian value investor credo to be greedy when others are fearful, but that doesn't mean you go in and buy every single oil stock.
Right. Yeah, and it's I think it could turn out ugly for a number, and particularly if you look at the midstream pipeline sector. I mean, these were sold on the idea that there was basically no commodity price risk because they were all operating under fee-based assets. And, as we've seen, those fee-based contracts are only as good as who the counterparty is on the other side. And if that producer, say that that company is transporting the gas or transporting oil from its facilities, if that producer is not able to pay its bills or going after 11, then that cash flow from that pipeline is not worth a lot either. So again, a lot of this stuff is yet to shake out, and I think we're going to see, as production does decline in North America, and as the market does right itself in terms of supply and demand, there's a lot of pain to be felt, and in areas where I think a lot of investors aren't expecting it. I mean, certainly the producers have gotten taken out and shot. I think a lot of the midstream companies have come down a long way too, but I think there's definitely some more pain to be felt there.
Yeah, we're starting to see evidence now. There is big production cuts, not announced yet. Actually not happening yet, but the announcements actually this week have started. We saw, I don't know if you saw it this week, we saw Whiting Petroleum come out, announce major production cuts, and Continental Resources, who are two of the largest producers in the Bakken shale play. So it's finally, like you said, that oil was generating pretty strong cash flow around $100 a barrel. They have cut their production costs quite a bit. They claim now that they were able to achieve cash flow positive at $50 a barrel oil, but we're not anywhere near $50 a barrel oil, and we might not be till towards the end of the year.
Yeah, that's absolutely right. And we talked about some basins being advantaged over others. If you look down in Texas, Eagle Ford and so forth, it's much more geographically proximate to the ability to export, the ability to refine, and so forth. But if you look at the Bakken, it's still a pretty remote area of the country, and there have been a number of pipeline projects proposed to bring oil down, but a lot of that oil is being shipped by unconventional methods such as rail that are more expensive. So, again, that basin is disadvantaged relative to some of the other basins around, and that's kind of, I think that's going to be a very critical factor is where these companies operate, and particularly if you look at the midstream companies. I mean, you mentioned two producers that are in a lot of trouble. There are a number of midstream companies that are right there with them in terms of that's where their contracts are. And, you get significant production cuts. That means cuts in throughput through those pipelines.
Do you think, we've seen Kinder Morgan slash their dividend. Do you think Kinder Morgan's, in a major bankruptcy risk being that large, or do you think they're well diversified enough to actually survive this bear market?
Well, I think Kinder has made a decision that a lot of the other companies aren't going to be able to make, and that is that they've taken they've just taken it for granted they can't access the capital markets on advantageous terms. Particularly not selling their stock, but that has places limitations on their debt. And that's the decision they made when they decided to really cut the dividend. But I think if you look at the fourth quarter that they had, which was pretty steady, pretty much on target with what they were saying it would be, what you really have there is a company that's going to be funding all of its projects with internally generated cash flow. So actually, that's the lowest cost cash or the lowest cost capital is whatever you're generating at the core business. A lot of that's and again, a lot of that cash flow is pretty steady. It's through basically fee-based operations. A lot of diversification. A lot of those pipelines and other assets that they have, the counterparties are actually pretty far from the wellhead. So they're, perhaps refiners or distributors or other types of companies that actually have been benefiting from softer energy prices because softer commodity prices have brought more demand. We actually have seen more demand this year for oil and refined products. So these companies, so that's another key distinction, I guess, between these midstream companies is you got some that are very heavily concentrated. Their contracts are heavily concentrated near the wellhead. In other words, with these producers that are really running into trouble. But you have other outfits that are more focused downstream, or they're focused on natural gas. Kinder Morgan, for example, ships a lot of natural gas to electric utilities and to natural gas utilities. So those are the counterparties there, are these highly rated investment grade utilities where you really have the default risk is practically, or for all practical purposes, is zero. So again, a much different proposition for them in terms of visibility on that contract revenue than, say, it would be for a midstream company that has a lot of presence in the Bakken. Kinder has some presence there. They also have some carbon dioxide production, which is actually directly tied to commodity prices. But all that aside, because they're so big, because they are diversified, and because they have these other growth areas that they're investing in, like exports to Mexico, like shipping gas to utilities that are actually growing, then the overall picture is fairly stable. So yeah, I mean, to keep a long story from getting longer, I think Kinder will survive, and I think it's actually one that eventually is going to be worth a lot more than it is now. But again, I wouldn't draw too many conclusions that any company can do that. In fact, I think when you see most of these midstream companies, if you see them cut the dividend, you're going to want to be out of that position, because it's going to be the sign of worse things to come.
What are some of the safer midstream master limited partnership companies or oil companies that you think have good balance sheets and their business models are protected, insulated from commodity price risk, the oil price going lower to the price forecast that you see?
Well, I think one that investors should take a look at would be Spectra Energy Partners. And I mentioned that Kinder Morgan has a focus on pipelines that ship natural gas to regulated utilities. That's a very big part. That's a much bigger part of Spectra's. Just looking at their counterparty risk, something like 92% of their cash flow is coming from investment grade companies. 75% of their projects are driven by demand pull, what they call demand pull customers. So they'll be like Florida Power and Light, for example, or affiliates of Eversource. Those are two major customers. They're both very strongly investment grade. So again, they're all in the right places. SEP is the symbol on that one. They haven't really been under that much pressure. Their credit rating's pretty solid, BBB. Their cost of debt's pretty low. Their share price, even going back over the past year, you look at the return on that, it's mid-single in the red, but mid-single digits in the red, and that compares, of course, to the broad-based index, the broad-based Alarian index, negative return there of about 42%. So it has been an outperformer for those reasons, but you look at it just in terms of a value proposition. You got about a 5.5% yield. You got a dividend that's been growing at an upper single-digit rate very consistently. They're putting these new projects into which are all pretty much, as they say, on the demand pull of the equation. So really, cash-strapped producers aren't a factor, aren't a threat to that kind of the visibility of their growth, and it looks like a pretty bright future. This is the kind of company that can really benefit from a lower for longer environment. And what people forget, that even in the midst of this energy market meltdown, there are areas of the energy patch that are really seeing explosive growth, and one of them being gas being shipped to utilities, because we've had this massive ongoing shift from coal-based plants, older coal plants that are actually much more expensive to run. They're much more polluting. The commodity is actually more expensive than gas. So it's no wonder that you see this massive dash to gas, and the companies that are able to build those pipelines and get that product to those utilities are basically minting money. And again, a company like Spectra still has a pretty modest cost of capital because it hasn't really been caught up in this massive sell-off. and in that industry group. One could argue that they should be trading at a much higher valuation. I think they probably will be. In the meantime, it's the kind of play that did well back in the last lower for longer environment, which again, a supply-based decline in energy prices back in the late 1980s. The Spectres did very well. So Spectre Energy Partners would definitely be one to take a look at.
I want to ask you now, Roger, about the oil majors. So Chevron, ExxonMobil, those types. Are you surprised these guys haven't slashed their dividends yet?
Well, I think they made a big deal out of maintaining the dividends, and so particularly the more Anglo-based ones. So whereas you have seen companies like Repsol, that was just announced, they cut their dividend. Eni, the big Italian super oil, they cut their dividend as well. So but on the other hand, you're seeing BP, for example, really almost kind of crazily decide to maintain their distribution, even though they have so many cash outflows, and they basically have decided, I guess, to go ahead and sell assets as opposed to and as opposed to accessing the capital market or cutting the dividend. Now, of course, as some industry executives have said, this is an absolutely horrible time to be out there trying to sell assets. And, everybody knows that. These companies really need the money. And the more assets that they have to sell at distressed prices, the more, the harder it's going to be to raise that capital. So, so far, I'm not surprised that a lot of these companies haven't started cutting dividends. I do expect to see some of them cut dividends, though. BP would be right up there at the top of the list. I think Exxon and Total are probably the least likely to do that. Royal Dutch, they just completed this big merger with BG. They've been telling everybody they're not going to cut the dividend, but they are going to have to make some adjustments to make that work. Obviously, when they made that deal, proposed that deal, LNG prices were at much higher levels around the world. So, it's a changed world. It's a world where companies have to move, and including super oils, which, are very strong and are able to have a lot of levers to pull to maintain dividends or maintain balance sheet strength. And I think a lot of these will do that, be able to do that in a $40 to $60 per barrel oil world. But not without some painful adjustments. So I do think that BP, and in fact that one does yield a little over 8%, which I think is giving you something of an indication that the dividends are going to be at risk. I do think even if these companies maintain the dividends, companies like Chevron, they're still likely to have one more drop in their prices, one more whoosh down, I guess. We've had what we call a dream buy price at 70 for Chevron, and that's it has been reached once. It was reached back in late August. We think there's a fair chance it could be reached again. So I guess overall advice for these super oils, take it easy. They will be, I think, right at the top of anybody's shopping list at some point. And when we do get that final bottom in, we may not get back to 70 again on Chevron. I mean, that seems like a pretty long way down. That's about a 20% decline from where we are here. But I think it is worth waiting on to buy these things. And until we see, at least we get some sort of comfort level that the bottom is in for oil. And again, the lean time of year for oil prices, for oil demand is coming, and storage facilities are pretty full. We're already at a pretty high contango, which is basically the difference between current price of oil or near-term prices for delivery for oil, and longer term is represented by forward contracts or futures contracts. So these are all things to look at, and we think there will be that final whoosh down, probably a final kind of a panic in some of these stocks, and that would be the time to make the move. But I think as far as dividends go, again, some are more likely to cut than others. I think that Chevron's probably one that will. They have a few more levers to pull. I do think that a lot of the reason that they're running these cash flow shortfalls right now has to do with the capital spending that they have to do to wind up some of these projects. And by 2017, we're going to start seeing production increasing from a lot of these long life projects, and at the same time, their capital spending is coming down. So that'll be a pretty big deal. But in the meantime, I think I'd be surprised if they did cut the dividend. I don't think we're going to see certainly not any dividend increases, though.
Yeah, if these large oil majors were thinking more long term, they would be out looking to buy some of these assets, these fire sale assets, maybe some of these mid-tier shale producers out of bankruptcy, or some of these quality deepwater assets out of bankruptcy. But we haven't really seen that to a large extent yet. So I guess maybe some of the companies who do have better balance sheets, I guess it's a buyer's market down now, and they're being patient with their acquisitions.
Yeah, I think that's absolutely right. I mean, definitely, we've actually heard a lot of the executives say that. We've seen some deals, for example, Repsol, when it bought a Canadian company, Talisman, that was pretty early on in the drop in oil prices, and I think they probably come to regret making that deal at the price that they did. And I think it served as something of a cautionary tale for the remaining companies out there that have those deep pockets that they can make these deals. There will come a time when Chevron and Exxon, I think, will strike. I mean, we saw that definitely happen in the last lower for longer period, where both these companies really transformed themselves for a longer term. Exxon by buying Mobil, Chevron by buying Texaco somewhat later. But they basically transformed themselves, became much bigger and stronger companies by making those moves. But they waited. They didn't. Those weren't moves that were made right out of the gate, right after the Saudis stopped being the producer of last, or the swing producer back in '85, when they stopped doing that, similar to when they decided not to do that, in 2014. We're still pretty close to that, and we haven't really seen any kind of bottom. So, but again, Chevron can make a lot of money at $40 to $60 oil. Exxon can make a lot of money in that range. Total, some of the stronger companies, and I think at that point they're going to feel comfortable enough to go out and do some of these deals. It's also significant, I think, that because Chevron and others really embarked on these very heavy capital project to build long life reserves. Chevron, a number of a couple of big LNG facilities in Australia, some deep water drilling in the Gulf of Mexico that's become very profitable, some LNG off the coast of Africa, really big projects that took a number of years to build. They started building them at much higher oil prices, and those projects, based on a return on capital, are not going to be as profitable, at least initially, as they thought they would be. But what that does, in effect, is it's tied up their capital until those are built. But once they're built, they're going to have a lot of production coming online to replenish what they already have. Their capital spending is going to drop pretty substantially, and at that point, they're going to have a lot of cash. They're going to have rising production, and they're going to be in a lot better position to consider whatever deals are out there. It probably is going to be a very nice confluence of events for them, because that's going to be the point where a lot of the marginal people out there are going to have really pulled in their horns, and I think you can potentially see some bankruptcy filings. I think we're going to see those fairly soon, but Chevron will then be in a pretty good position to take advantage. Exxon as well, and if you look at the midstream space, some of the larger names, I think Kinder will be there, at Enterprise Products Partners. Again, the companies that have the deep pockets and are able to continue keeping on and maintaining a low cost of capital, and as long as we're in the teeth of this thing, they're really going to be in much stronger shape, in very good shape to consolidate. It's just not going to be, as we conceive of mergers where and takeovers where the target is always the biggest beneficiary. I think in this case it's the acquirer who's buying at distressed prices.
Yeah, I completely agree. I think there's going to be a lot of bankruptcies in the near future. I think we could even see, entire governments or, national oil companies go bankrupt. I don't know if you cover Petrobras, but I was looking through their financials, reading, the management's comments on their liquidity risk and things like that in August and September of 2015, and they were talking about how they needed to sell $60 billion of assets as soon as possible, and they needed to raise money from Asian and Chinese banks because no one else would give them any more capital. So I saw those as huge red flags. I think we could see, potentially Petrobras going bankrupt and other large major players, perhaps even countries that produce oil going bankrupt if the oil price doesn't start to rise maybe by the end of the year.
Well, it certainly wouldn't be unprecedented, would it? I mean, we actually saw Russia go bankrupt at one point back in the 1990s. But, at this point, I think that's definitely a possibility for some of the companies out there. And, Petrobras is a pretty good example. And they have, of course, the huge mess of corruption, the corruption scandals, and the fact that, the home currency in Brazil has lost about a third of its value this year and 2/3 of its value going back over the last 2 or 3 years. And, the economy there is shrinking. So that's their major market on the downstream side. So, yeah, those types of companies, there's really no point in anybody jumping into them. I know a lot of people like to look at things that come down. I'm certainly in that camp. And, you want to draw the conclusion that, hey, it's down this much, it's got to be the screaming bargain of the year. But I think, in energy, you really want to be careful with that. We did have that really fast recovery from 2008, 2009 into 2009, 2010. Prices really came back in a hurry. But keep in mind, that was a demand-driven drop in the price of oil. People were worried about the global economy shutting down and, consumers not being able to buy. And, the whole market froze up on that basis. And once, the worst passed for the global economy, it was pretty easy for oil prices to come back. This is going to be a lot harder. I mean, you are going to have honest-to-goodness production cuts. And, North America is a prime place where that's going to happen. But, look at some of the areas like the pre-salt, which, we're talking about Petrobras. That's a process where they have to go a mile down basically to get to the ocean floor. Then they go a mile through a layer of salt, and then they, go a mile down through there. So it's a tremendously expensive, technically fraught with process fraught with a lot of technical difficulties. And in fact, about a year ago, Chevron was under some of their executives were taken to prison, and the government was threatening them with huge damages for what was actually a relatively minor leak, which wasn't even their fault really, down on the in the pre-salt off the coast of Brazil. So again, that's a high cost area, and the high cost areas are the ones that are always the most in trouble when prices come down. I throw another one at you too, Canadian oil sands. That's an area that's very remote, and in fact, mining the tar sands is actually a chemical operation, a mining operation more than conventional drilling operation. So even the lowest cost producers there have pretty high costs in terms of getting their product out. We haven't seen even production really decline there just because there's so many technical problems with, shutting down output in these extreme weather conditions. But, that's certainly a possibility. And once a company does shut down something there, it's going to be really bad news for them. I think, it was nice for Canadian Oil Sands, the company, to be acquired by Suncor, because Suncor is almost certainly going to be a survivor coming out of that. They have a lot of downstream, they have a lot of conventional energy, and they're also just large and they have scale. But that was that's one of the lucky ones. I think there was a lot of opposition and resistance among the Canadian oil sands, some of the Canadian oil sands shareholders, and certainly the management about that deal. They thought Suncor was getting away with cheaply. I think maybe in the next couple of years Suncor might come back to look at that as not the case. Maybe they even paid too much for it. But that's again another area of the world where there's been a lot of effort, a lot of money spent, but still very high cost area, and it potentially at risk to even though a lot of the players there are very very deep pocketed, and there is consolidation going on. It's still an area where you could potentially see some carnage, particularly in some of the weaker names. So
my final question before I let you go has to do with Russia, Saudi, this oil production freeze, where they're agreeing to not increase production anymore. Do you think any of these guys are going to actually decrease production in the near future, or do you think then it's going to be the shale oil producers, deep water oil sands that are going to be the ones that are going to drastically decrease production then?
Well, I mean, first of all, you have to look at both of those countries. You look at what they've actually pledged to do, and that is basically freeze production at historically high levels. So, that's not they haven't really committed to doing anything. And the other thing is that particularly the Saudis. I mean, they're very much incented to keep prices lower. I mean, we mentioned the shale producers and forcing cutbacks there. I mean, they're even more opposed. I mean, they're looking across their own region there, and their arch rival there, Iran, is now able to produce and sell oil with the sanctions lifted. So they're not in any hurry. But one thing, Iran is also a much higher cost producer than the Saudis. So they're not in any hurry to bring prices up and put more money in Iran's pockets when the strategy has actually worked out pretty well. And so here they are, they're producing pretty high, extremely high levels. They've said, oh yeah, we won't produce any more. They certainly could. They certainly do have that, production they can bring on. But bottom line is everything's kind of working out in their favor, and they are going to get those production cuts in some of the higher cost regions, and the price will rebound. And also at $40 to $60 oil, there's a lot less incentive for alternatives. Alternative fuels and so forth, and they're definitely mindful of that. There was a speech by the Saudi oil minister the last couple of days. What really impressed me about that was the whole second half seemed to be devoted to defending fossil fuels and continued use of fossil fuels around the world. So, the higher the cost of gasoline is, for example, I mean, the less incentive there is to use it, the more incentive there is to switch to something like electric cars, for example. This is always the thing that they are, they're fighting against, in the 70s and 80s. That was another big reason, I think, why they, decided, well, we're not going to be the swing producer anymore. Their oil does have some competing fuels. It's definitely on top of the company that is viewing the world 50 years hence, because it does have these very long life oil reserves that really account for most of the wealth of that country. So, if anybody's expecting the Saudis to do anything to drive the price of oil back to $100 a barrel anytime soon we think is dreaming, and that's not a very good investment strategy. And, as far as Russia goes, I mean, that's knows what's coming out of there too. I mean, we can look and see what BP has been talking about, and they've had their own set of problems there regarding currency and so forth. But I don't think that this is going. I guess the bottom line is, this has made a lot of headlines. It's actually driven oil prices up a little bit. We were in the high to mid 20s. This has gotten oil back up into the very low 30s, but we think this will basically run its course, and we will see oil take that final whoosh down, which will in turn give us a really good opportunity to buy. Now, it could be that that this doesn't happen, that oil doesn't take that final whoosh down, and we just hang out in this particular price range again. Keep in mind that the weaker players out there can't make it at even at this level, let alone a drop to 20. They can't even make it at $40 to $60 a barrel. So again, another good reason to be careful, and particularly to watch out for when a lot of hype and there are these rumors that come out where some foreign producers bail out the global price. I mean, at this point, the Saudis have no incentive to do that, and again, keep it there. All they've done so far is offer to freeze production at historically high levels. So again, a lot of it's a big market. There's a lot of emotion swirling around, but it's a time to be patient, pick your spots, and realize that the real money in this market's really made over the long term. That's how the Saudis do it, and that's U.S. investors. That's how we will do the best, thinking in that kind of a vein.
Yeah, Roger, I think that's really sound advice. I think the only country that may be in jeopardy of having to cut oil production is Venezuela, and that's because, they're going through hyperinflation right now. They have the military, I think, guarding the oil fields. I think they're desperate to get a loan from the Chinese to come in there, and they may have to give away some of their oil. But, that's the only one, just because their whole economy, their whole country is totally mismanaged by their politicians. But the rest of the other oil-producing countries, they need the oil revenue, even though the oil prices are lower. They need that's like their only major source of revenue, like you said. So they basically have to keep putting out at maximum, because even if the oil price goes lower, they need to increase the revenue somehow.
Yeah, and that's why it does take a while for these imbalances to correct themselves. That's why the cycle, any commodity price cycle, and particularly oil, it tends to be over a period of years rather than months. So again, another good reason, you just said to take it easy strategically. We have a trading service, and we've done pretty well with the more near-term fluctuations in energy. But for most investors, and really most of the money is going to be made, by again making a longer-term kind of strategic bet, but mainly realizing that the prices have brought a real retrenchment and in this sector, and not every company is going to make it. So just because something has been knocked down a long way doesn't mean it can't get knocked down even more, and probably will.
Yeah, and then even if a company gets bought, it's not going to get bought out at a good premium because it's a buyer's market like we discussed. I just want to thank you again for your time today, Roger. You've been a wealth of information. I've known you for a couple years, and I know your business partner, Elliot Gue, too. We've had him on here as well. How can our listeners, if they want to try out your oil newsletters, how do they do so?
Well, you can go to energyandincomeadvisor.com, and that's just as it sounds. You can Google that, just Energy and Income Advisor. If you want to contact us directly and phone in 1-877-302-0749, and that's 1-877-302-0749, and that's Sherry's our customer service director, so you can find out more about Energy and Income Advisor. We also have a trading service, Pig versus Bear. We have a newsletter called Conrad Utility Investor, and we have Capitalist Times. So those are our products, and we'd certainly like anyone who's interested to check them out.
Yeah, it's very interesting times in the oil market right now, but it looks like there's going to be more pain before more gain.
I think that's kind of the bottom line, and again, try to establish positions strategically. You might pick a price that you don't think is going to be reached under whatever the circumstances on the downside. We call those dream prices, actually. And you pick a price there. You maybe set a buy limit order, and if that price is reached on a particularly bad day, I think we're going to have some more. Then you're in to say a company like Chevron under $70, or EOG Resources under 50, or Schlumberger under 50. You're in a company that you can really hold with confidence for a long period of time. It's going to benefit from this lower for longer environment, and without taking a lot of risk, and you're getting in at a very good price. So I think that's maybe one way that for people to get involved. But you mainly want to just invest strategically and carefully. I think there's going to be a huge we're going to make a lot of money if going forward as this recovery unfolds. But not here yet.
Yeah, I agree. I think in 5 years from now, the oil price is going to have to be at least substantially higher. I don't know, maybe even double just for companies to even think about increasing production again. Once we see all these bankruptcies start to accelerate, the oil price is going to have to go higher for some type of incentive again for, replacing reserves and exploration and things like that.
Yeah, that's right. I think, and that's one reason to have that $40 as a lower side. I mean, that's kind of a minimum for a lot of the world's production to be economic. 60 is the higher level because there's a lot of production that can come online and be very profitable at that price too. So that's kind of the reason why we have that sort of longer term range in mind. And again, only a certain number of companies can be consistently profitable over that time. When with prices off as they are and the market melted down as it is, you do have an opportunity in those, but an emerging opportunity. But again, being selective and being careful, I think it's never been more important.
Okay, great. Well, thanks again for your time. I really enjoyed the discussion.
I did too. Thanks for having me.